Welcome, everyone. Thank you very much for joining us today for today's Global Growth Investing webinar. My name is Audrey Melville, and I'm the Marketing Director here at Gabelli Funds and your moderator for today's session. And I'm thrilled to be here today with my colleagues Howard Ward, Caesar Bryan, and John Belton, who will help us discuss the complex global growth investing landscape. For those of you that aren't familiar, Gabelli Funds is an asset management firm founded by Mario Gabelli in 1976. Today, we manage over $30 billion in client assets across a broad set of asset classes, investment strategies, and vehicles. Howard, Caesar, and John are all portfolio managers at our firm with several years of experience. I won't tell you the exact number, but they collectively manage the Gabelli Global Growth Fund, ticker GICPX. So really excited to talk to you today about global growth investing. Thank you guys for joining me.
Thank you for having us.
Yeah, so I guess let's get started by talking about the historical context and providing a little bit of background information around global growth investing generally and some of the origins of the Global Growth Fund specifically.
Sure. Thank you, Audrey. So I should mention that this is actually the 30th anniversary of the Gabelli Global Growth Fund. But when it was launched in 1994, it had a different name. It was launched under the name the Gabelli Global Interactive Couch Potato Fund. Yes, Gabelli Global Interactive Couch Potato Fund. It was run by Mario. And it was predominantly a TMT fund or technology, media, and telecom. And that was an outstanding decade to be investing in that sector of the market. And then at the end of that decade in 2000, of course, we had the dot-com bust or the boom that went bust. And at that time, we made the decision to change the name of the fund to the Gabelli Global Growth Fund. And then in 2004, Caesar and I assumed management of the fund. And so this is now our 20th anniversary. Now, as we start this conversation with you, I think that it's important that we try to establish some credibility with you in terms of our investment performance. I mean, that is essentially what we are selling. And it would be foolish for us to waste your time by telling you how great we are if we couldn't support that with our record. And so I have a few comments on that to start. And I have to say that I always have mixed feelings when talking about performance, because if you've had a bad year, of course, it's not a very pleasant experience and you feel ashamed. But if you've had a good year, that's pleasant. But you can't help but think, gee, am I going to jinx things? And from here on in, it's going to get more difficult. I'm going to take that risk. And the first thing that I'd like to comment on is some awards that we've won over the last 10 years. These are Lipper Awards, and they are based on performance using a proprietary Lipper risk-adjusted formula. And so we've won 7 awards in the last 10 years. In 2014, we won the award, the Global Growth Fund won the award for the both 3-year and 5-year returns. In 2015, the same, it won for 3 years and 5 years. And then I think more importantly, we won the 10-year Derby in 2019, 2020, and 2021. I'd also like to bring in our benchmark and talk about some comparisons there. But before I do that, I'm going to ask John to give you an overview of what exactly that index is all about.
Yeah, so our benchmark is the MSCI All Country World Index. So I did a little bit of homework for Howard over here. So I've got my notes. This is market cap weighted index, a little over 2,800 constituents spread across 47 countries. 23 developed market countries and 24 emerging market countries. Now, if we look at the index weights by country, it's about 90% in developed markets and 10% in emerging markets. And more specifically, it's about 64% of the index is US companies. Close to 16% is Western Europe. So collectively, 80% of the index is in US and Western Europe. And then the remainder, there's about a 5% weighting in Japan, just under 3% in China. What's interesting, I mean, Howard referenced sort of how some of the funds holdings or some of the kind of underlying holdings have progressed at some of the different cycles that have taken place over time. One thing that struck me when I was looking back on this, so if we look at Japan, and we'll get into this in more detail later in our discussion, but Japan's currently about 5% of the index. It was 40% of the index 40 years ago. And conversely, the US, about 65% of the index, give or take, it was only about 33% of the index in the 1980s. So clear, shifts in the weightings over time. If we look by sector, about, let's see, 35% of the index is in, TMT, 25% in IT, and another, call it 10% in communication services. The other big sectors in the index, financials are about 16%, healthcare and industrials, each about 11%. And similar comment on how that's changed over time. IT, it's been volatile through different cycles, but IT was only, sub 10% of the index in the 90s, 25% today. So that's obviously been a big, increasing mix of the index. And then for context, just thinking about some of the largest constituents. So the top 7 constituents in the index: Microsoft, Apple, NVIDIA, Amazon, Meta, Google, and Eli Lilly, is about 20% of the index. I think that's probably leave it there for now. That probably gives you enough to work with.
Yes. Okay. Thank you, John. And since I am going to talk about some performance, I should say that past performance is no indication or guarantee of future performance. Returns vary. We have good years and we have bad years too, just like anybody else. But I do want to talk to you about the 20 years that Caesar and I, and now John, who joined us in February, about the 20-year period that Caesar and I have been managing this fund. I reviewed the returns for the latest 12 months ending June 10th, so just a couple of days ago. And we looked at the trailing 1 year, 5 year, 10 year, 15, and 20 years. And I compared the Gabelli Global Growth Fund to our index, the MSCI All Country World Index, but I also wanted to throw in some other international indices. And so we also looked at the MSCI World ex-US Index. We wanted to look at the MSCI Emerging Markets Index, and we wanted to look at the MSCI EFA Index to see, how has the Gabelli Global Growth Fund done compared to not only our benchmark, but to some other indices that are used to track international investments. And I'm pleased to say that over every one of these time periods, 1, 5, 10, 15, and 20, we outperformed all of the different indices. And so I should also point out that that's different from outperforming in all of those years as we were going through the past 20 years. And by that, I mean this. In the early 2000s, the emerging markets went on a tear as primarily a function of their economies being commodity-based and China having a massive fixed asset investment boom. And also they were helped by a weaker dollar because commodities are generally priced in dollars. And so when the dollar goes down, the demand for commodities is likely to go up. And so there was a 10-year period there from 2002 to 2012 where the emerging markets did very well. They became very sexy in the world of global and international investing. And they outperformed basically all of the developed market indices that I've talked about by about a multiple of 2, compounding, 12, 13% versus more like 6 to 7 for the other indices. But since then, the emerging markets have lagged. But I wanted to point that out, that this hasn't been a period of 20 years of bliss. And there was some difficult times in the early 2000s but the outperformance of the style since then, for the last decade, or really since 2009, has been so strong that it has more than compensated for the underperformance in the early 2000s. Now, at this point, I think I'm going to ask John to comment on some of the investment themes that we are writing today.
Yeah, sure. So I think I'll start by saying, and I think we'll get into this in more detail later, but to start, this is a bottoms up strategy. We're looking for the best companies, regardless of countries or sectors or anything like that. And I'll start by saying 68% of our portfolio is in U.S. domiciled companies. But when we look at the business mix among those companies, it's less than half of the revenues are coming from the U.S. So this really is a global portfolio. And so when we think about the investment themes that our companies are benefiting from, I'd say generally they are global themes. And so some of our favorites right now, semiconductors, global semiconductors serving global end markets. There's a couple of secular tailwinds behind the semiconductor industry. First, increasing semiconductor content in various consumer applications, business applications, industrial applications. And then secondly, increasing complexity in semiconductor design architectures. And so we're kind of participating in these themes through holdings like NVIDIA, ASML, LaserTech, and Applied Materials. Second theme that we really like, digital media. What's really interesting about this in the context of a global growth investing framework is a lot of the strongest media companies today have become so strong because they've gone global. So you have companies like Google and Meta on the internet media side. And then on the entertainment side, Netflix and Spotify, two companies who really unlocked a huge growth potential when they expanded internationally, when Netflix expanded from the US globally and when Spotify expanded from Western Europe. It's a Swedish company when they expanded globally from there. And the global expansion from those companies, it's really unlocked a whole lot of growth and a whole lot of profitability. Because in many cases, these are fixed cost businesses. So global expansion has been a great way for them to spread these fixed costs across more subscribers, across more revenues effectively. Third, global consumer brands. So some of the holdings in our portfolio, things like Louis Vuitton, Christian Dior, and L'Oreal, like companies that have brands that scale globally. And I think that's become a big competitive moat for these companies. It's allowed them to generate long-term growth over many years. One company that's much earlier in the growth cycle under this theme is On Running. We're very excited about that. As sort of started as a specialty footwear company, it's really expanded globally and gotten into more categories. And we can talk about any of these themes more. I don't want to take too much time, but just to rattle off a couple more. Digital transformation, another area we have a lot of exposure to. Electrification and industrial technology. We're very excited by sort of the increase in the world's energy consumption from electricity, 20% today, going to 50% longer term. So companies like Eaton, Schneider Electric, Trane Technologies, and GE Vernova, some holdings that we participate in this theme through. And then on the healthcare side, we like some of these med tech companies doing things like robotics, and some of the pharma companies that like Eli Lilly and Novo Nordisk that are really changing the world with these new GLP-1 drugs. I'll leave it there, and we can get into any of those in more detail later.
Great. Thanks. That's a really, really helpful overview and introduction to the fund. And what our audience can't see is that Howard is wearing his On Running shoes today. So
I'm not going to show you those.
but no, thanks. So, and then just to zoom out for a second, would love to talk about more broadly the historical rationale for investing globally. Caesar, maybe you can kind of explain the historical context.
Thank you. This is a little bit of a history lesson. But in the early 1980s, most institutional portfolios were invested almost in their entirety in domestic securities. Then pension consultants discovered and promoted the idea of that having some exposure to non-US equities added not only to performance, but also lowered portfolio risk, i.e. volatility. But domestic and international equities were considered different asset classes, and the allocation between them was carefully managed and monitored. But as so many companies, as you just heard, operate on a global basis, did it really make sense to regard US and international equities as two separate asset classes? Why not think of equities as a single asset class and build a portfolio of best ideas and companies without the somewhat artificial constraint of geography? This led to the growth of global equity investing.
Great. That's helpful. Thank you.
I might just, if I can just interrupt, just to add to that, that I think that the textbooks or the advisors that you might talk to about global investing, I think that most people are going to tell you that the efficient frontier for equity allocation globally is somewhere between 70-30, 70 being US, 30 being foreign, somewhere between 70-30 and 60-40. And as John noted at the outset, many years ago, the US market cap weight of this index was 35%. And I think when Caesar and I got involved in this fund 20 years ago, it was around 40% or maybe slightly over 40%. And today it's 63%. And I'd like to point out that because we're trying to invest in best of breed companies wherever we can find them, the fact is, in the world of growth stock investing, you're going to find a greater universe or target rich environment for growth stocks in the US than anywhere else. So we've always had a position in the portfolio of being overweight the US. So when it was, let's say, 40% of the index, we would have been 45 or 50. And as the US has slowly but surely outperformed the rest of the world over the last 20 years and grown to be 63% of the index, we've continued to maintain that overweight, so that, as John mentioned earlier, we're at 68% today, which sounds like a lot, but it's just 5 percentage points over the index. And it's actually right in that sweet spot of the efficient frontier that historically had been viewed as the proper allocation between domestic and foreign, right near that 65 to 70% area, which is where I expect we will continue to be for at least some time. We own 40 companies right now. And again, just to contrast that to the underlying benchmark, which has, I think, over 2,500 companies, as John said. So this is a fairly concentrated portfolio. And our approach, as I think you know by now from the comments of John and also Caesar, it's really a bottoms-up approach. I would argue that the typical approach to investing globally or internationally is top-down. And you're going to be analyzing GDP rates, nominal and real, and inflation rates, and productivity levels, and labor force growth. You're going to look at all kinds of exports, import growth, expectations on the currency. You're going to get a really complicated multivariable model, believe me. And then you're going to be making bets on how you want to be weighted by country. And then you'll try to fill those in by looking for the investments to help you rationalize those targeted weightings. That is exactly not what we do. We really simplify the process by focusing on the individual company. Again, we only need 40 companies. At any one point, we might own 35, we might own 45, but we think that's a big enough list to give us enough diversification, because the objective here is to outperform. And we think the best way to do that is to put our best ideas forward in a meaningful way. it's easier for us to take a meaningful position in our companies because we are buying arguably great companies. If you're investing in average or mediocre companies that, maybe they look particularly cheap or have some other catalyst driving them, that's fine. But I think it's more difficult to be confident about taking substantial positions in companies that you don't have as much confidence in. We're really focusing on the dominant companies that have extremely strong vault-like balance sheets with lots of free cash flow. We love free cash flow. We think that's an important metric, as is revenue growth. If you could actually distill this entire process down to one metric to help guide us in our investing, it would be organic revenue growth. That is the key variable for deciding the kind of multiple that your underlying company is trading at. And then the earnings growth, of course, will help to power that share price over time. So that's the way that we go about this. And I would point out that this is a long-term approach to investing. We like to own companies where we can benefit from the teen level compounding of earnings over a period of time. And so just to point out some of the long-held stocks that we have in the portfolio, among our foreign stocks, Keyence, which is a Japanese maker of electronic sensors that are used in factory automation. We've owned Keyence for over 20 years. And during that period of time, it's been a 10-bagger for us in the portfolio. It's an extremely high quality company. LVMH, which is the world's largest luxury goods maker, we've owned that company for 9 years. It's now the largest market cap equity outside of the United States, I believe. Correct, Caesar?
Yeah, it swaps that and Novo.
Right. And Novo Nordisk, which is actually another name that we own. We haven't owned that one as long as some of these other ones, but we've owned it for a couple of years, as we've also owned the other GLP-1 mega hit, which is Eli Lilly. L'Oreal, another luxury name from Europe, has been a holding for 8 years. This has been another terrific compounder for us, and we think it has a lot of years of growth ahead. On the domestic front, we have some long in the tooth investments. Apple, we've owned for 11 years. Alphabet, we've owned for 12 years. Amazon, we've owned for 16 years. Microsoft, we've owned for 15 years. Again, we're trying to ride the compounding of earnings growth by investing in great companies. Oh, you've probably heard of this other company called NVIDIA. We own NVIDIA, but we've owned it for 5 years. We paid under $5 a share for it, and it's now over 10% of the portfolio. It's our largest holding. So that gives you a feel, I think, I hope, for how we go about investing and for the kinds of companies that we invest in. And I'll stop there, Audrey.
Yeah, thanks. So really, really helpful. I think kind of helping to explain to our audience how our approach is unique in the global growth investing landscape. And I know we touched on performance, but just circling back to a question from the audience, can you also tell us about the AUM of the fund? And you touched on this, but annual turn.
So the AUM is $180 million today. The annual turnover varies from year to year. I think in a typical year, and probably last year as well, that turnover rate is around 30%, 35%.
Great, thanks. And you touched on this, but want to dive a little bit deeper into your management process. So we talked about the bottoms-up approach for selecting the best growth companies globally. Can you elaborate on specific characteristics you look for, how you think about valuations when looking at companies to invest in?
Yeah, I mean, I think Howard has, covered this pretty well. So, this will be a little bit repetitive, but just remember, this is a growth strategy. And we're looking for companies with sustainable revenue growth, generally a high single digit, as Howard said, or double digit, along with double-digit rates of earnings growth. And obviously, we invest for the long term, benefiting from the compounding effect of earnings. And for a growth strategy, turnover is lower than average, I would suggest. So, we invest in companies that have a powerful and sustainable competitive advantage, high and growing market shares, and that serve expanding end markets that John highlighted a minute ago. Our companies have high returns on capital and equity, and of course, strong balance sheets. It can be considered a large cap strategy. For example, currently there are 10 holdings that have a market cap less than 100 billion, which represents about just over 15% of the portfolio. Of course, that could change over time.
Great, that's helpful. Thank you. And when Howard mentioned that 63% of the fund is held in US-based companies, so when thinking about geographic areas for potential investment, are there any particular areas or countries that you look for?
So again, because we're trying to invest in the best, it's primarily outside the United States. It's primarily countries in Western Europe. So right now, for example, it would be Denmark, Sweden, France, Ireland, and Japan also. And at this point in time, that may be pretty representative of the non-US investments that we have.
I would just add here, I mentioned it earlier, but it's important to realize, so that is defined by where these companies are domiciled, but defined by where they do business is a very different picture. I mean, I think on average, the companies in the portfolio generate about 55% of their revenues outside of the US. And those regions are pretty broad-based globally in every region, depending on the company.
Great, that's helpful. And so it doesn't sound like there are a lot of investments in emerging markets. Can you talk more about your view on investing in emerging markets?
Sure, let me take that. As I mentioned before, emerging markets were very sexy in the early 2000s because they were booming and outperforming the rest of the world. But again, that was during the big boom, fixed asset investment boom in China, which helped to drive global economic growth, but it was particularly a good thing for emerging markets that have a commodity-based economy. But since that building boom generally expired in the early 2010s, so like 2011, 12, 13, that sort of whiffed out a bit. The emerging markets have lagged, and they've been hurt not only because of the slowdown in China, which arguably is continuing, the slowdown that is, but also because the dollar bottomed in late 2008, and a stronger dollar has also worked against those emerging markets. And frankly, given the shape of the world today, in terms of geopolitical issues and demographics and productivity, I don't really see a expectation where emerging markets should have any kind of significant secular period where they outgrow the developed markets. It could happen on a cyclical basis here and there, but barring another fixed asset investment boom, I think there's a lot of challenges ahead in a lot of these emerging markets. A lot of them are going to face challenges addressing global warming. And we're already seeing that in some cases as the extreme heats are destroying crops and causing prices of certain agricultural goods to skyrocket. But it's going to be even more serious than that. Just living in the heat and dealing with the rising waters and the poverty that still exists in a very real way in many of these places. It's going to be a real challenge, I think, for some of the emerging markets. I could be wrong, it wouldn't be the first time, but that's my point of view today, and I'll reserve the right to change that point of view should the time come.
Great, that's helpful. So specifically, do you invest in Russia, China, or Taiwan?
No, but that's not always been the case. Although we've never invested in Russia, at least during the time frame that Caesar and I have been managing the fund. And that's because of the lack of the rule of law in Russia. And anybody that had investments in Russia, when Russia invaded Ukraine, I think they saw those assets get marked down considerably. I'm not sure how they've been able to salvage them. China, we had investments in until I believe it was early 2021. And that's was the beginning of the, I don't want to say anti-business or anti-capitalist, but it was sort of the beginning of more anti-wealth business rhetoric coming from the Chinese government, and a decision to promote the average man in China as opposed to building up businesses in China. And I believe that our relationship with China has deteriorated in the years since, with trade wars and increasing military confrontations at the margin with a boat here and there or an aircraft here or there, and with the rhetoric about invading Taiwan. And should China choose to invade Taiwan, I don't think that would be very helpful for investors in China, just like investors in Russia were not helped by Russia invading Ukraine. And it also would raise concerns about investments in Taiwan. And where we have invested in Taiwan on a couple of occasions in the past, when we exited our investments in China several years ago, we did the same with Taiwan Semiconductor. And that's because we fear that an invasion of Taiwan by China would result in a horrendous, disastrous catastrophe for Taiwan Semiconductor, but obviously it would be extraordinarily difficult for the entire world economy, since the majority of the world's sophisticated semiconductor chips are all made by Taiwan Semi in Taiwan. But we decided that we didn't need to invest in Taiwan Semi to benefit from that. In fact, John, why don't you talk about some of the suppliers to Taiwan Semi that we do invest in?
Yeah, I mean, I think to be clear, Taiwan Semi we view as a very good company, one of the best run companies in the world. I think it's now the 8th largest company in the world by market cap. I'd have to double check that, but and yeah, they clearly set the standards for the most advanced semiconductor manufacturing processes. So it's really more a view on geopolitical risks, because for Taiwan Semiconductor, those geopolitical risks feel quite binary. But to Howard's point, we invest in some of Taiwan Semi's most valuable and most crucial suppliers. So we have a good position in ASML Holdings, which I would say manufactures and supplies some of the arguably the single most important pieces of equipment in the Taiwan Semiconductor fabrication plants. We invest in Laser Tech, which has quite a complementary piece of equipment to ASML's lithography machines. And then we invest also in Applied Materials. Separate from Taiwan Semi's suppliers, we invest in probably at the moment, not probably, I would say certainly Taiwan Semiconductor's most important customer, which is NVIDIA. And we also invest in a company called Cadence Design Systems, which is one of the leading suppliers of semiconductor design software. So I'd say we end up sort of expressing a lot of the attractive views about Taiwan Semiconductor through our investments in other companies that are sort of on the same supply chain and benefiting from the same themes. But yeah, we do not we view the risk in Taiwan in Taiwan broadly as too much right now for Taiwan Semiconductor specifically.
And in fairness, Taiwan Semi is making massive investments outside Taiwan, particularly in the US and Japan, lessening their dependence. on Taiwan, of course.
Got it. No, really, really fascinating and a good segue into one of our questions from the audience. When you decide that you want to exit a position, how do you decide when to sell?
Well, as many of you know, it's harder to sell to be a good seller than to be a good buyer. And I would say I'm going to give you a couple of different answers to that, because as a general rule, when we are both buying and selling, we do it by scaling into and out of a position. This is assuming that there isn't some surprise negative announcement that makes us compelled to move more aggressively. We generally, these are very volatile markets. It's really the day-to-day price change on any number of stocks can be bewildering. And this is happening again today. It's like, wow. And so to be moving completely in or out of a stock in a market like this, all in one fell swoop, carries a fair amount of market risk. And so we prefer averaging in and averaging out. Now, generally, if we're going to exit a position, it's either because we feel it has become way too expensive to justify, and we're reasonably liberal on that, because if we're investing in companies that are compounding their earnings at 15 or 20% or much higher in the case of an NVIDIA, if you're compounding 20, 30%, you're going to overwhelm the premium that's built into the PE that you're paying, unless it's truly outrageous. You're going to overwhelm that in pretty short order simply by the compounding of your earnings growth. And so we know that, as a matter of fact, that the correlation between let's see, a price earnings ratio, a forward price earnings ratio, and the behavior of the stock in the next 12 months is completely, it's so small that it's irrelevant. It's not to say that valuation isn't important. It is. But you just can't predict with any degree as to when that time is going to come. And so we believe in letting our winners run. That's been a successful strategy. We do have a couple of holdings today that we have begun shaving a little bit. I'm not going to talk about them, but they've reached price levels that seem too high for us, at least in the short run. But we will sell a stock if the fundamentals have turned negative, regardless of the price. If we feel differently about a stock, about the reason that we own that stock is no longer valid, then we will exit it. And if we feel there's an upcoming, let's say we feel negative about a stock and they're going to report earnings tomorrow, we might want to get out of that whole thing today. And so we will move like that when it's required, but our preferred method of operation is to go a little slower. And there's a lot of wisdom in the notion that when there's some sort of a catalyst that makes you feel maybe you need to do something, rather than being a deer in the headlights and doing nothing or blowing it all out at once, just do something, do a little bit, and maybe things will be better in the next day or two, or maybe the news that you're working on today turns out to be not as important, or maybe not even true. So you have to be careful.
Yep, that makes sense. And that's helpful. So specifically, I know that you exited your position in Tesla recently. Can you talk about the decision and how you executed exiting Tesla from the portfolio?
John, you want to take that? I mean, that was just a straightforward one. Fundamentals deteriorating, and not not actually as comfortable with Elon Musk as the CEO as we had been previously, after reading about some of his extracurricular activities.
I would just add, I mean, I think what was amazing about Tesla for a number of years is you've always had these hopes and dreams about what Tesla could one day do with artificial intelligence and autonomous driving and robo taxis and all these sort of unproven moonshot bets, which are definitely exciting. But there was a number of years there where the core auto business was seeing incredible growth and was delivering industry leading margins. And you could really get comfortable around this core auto business being something to invest behind with a lot of these moonshot bets, sort of longer term upside. And to Howard's point, we started to see demand slow down. We started to see their deliveries slow. We started to see them cutting prices, which was eating into their profit margins. And moral of the story is the fundamentals just deteriorated in a way that we didn't feel comfortable with.
But that said, let me just add that the environment that Tesla is facing is all the companies are facing, all the auto companies are facing this, whether they're selling gasoline engines, diesel engines, electric, they're all facing a more difficult consumer environment right now. And let me also say that Elon Musk is a genius, and he's built a tremendous company, and has to have an incredible skill set for manufacturing at scale very quickly and with a lot of attention to detail and quality control and improvements ongoing. I drive a Tesla and I love it. I have no desire to drive anything else. So this is not we're not questioning the product or Elon's intelligence. It's really the primary issue has to do with the consumer and the slowdown that we see in auto sales. And it's difficult for the auto companies to react quickly enough when you don't get a lot of lead time to see how the consumer changes.
Got it. Interesting. So as we're thinking about, the consumer and the impact of the consumer on some of these companies, wanted to transition over to talking about some of the retail luxury holdings. Caesar, if you could kind of elaborate on some of those that we have in the portfolio and, if you're seeing any changes in consumer demand and how you're thinking about those in the portfolio.
Yeah, well, I mean, those companies benefited greatly from spending during the pandemic, and the market thought that the sales would decline quite rapidly, or the growth in sales would decline, and actually the companies thus far have been very resilient, and we've been focused in the largest companies. Right now, a big position in the portfolio is LVMH, which is the largest luxury goods company in the world. But they also do have some other investments, including in spirits, drinks, a big joint venture with Diageo, which is struggling a little bit now. But their basic luxury goods businesses has proven to be very resilient. As I was talking about the slowdown in the consumer. But actually, there's been a bit of a bifurcation. The high-end consumer is proven to be resilient.
Great, really interesting. I think at this point I'll turn it over to some questions from the audience. We've already had some great ones, so feel free to continue to ask us questions in the chat or in the Q&A here on the Zoom. So another question from the audience is talking more about your process. Do you visit with management teams, do field research, or are you principally evaluating published information and financials?
I will take that. It's a little bit of all the above, but let me tell you a little story about what happened during the dot-com boom and bust. Because at that point, so 24 years ago, I was going to a lot of conferences and visiting companies, and primarily in the tech sector. And this was we were into the decline. And I would say a number of these more expensive tech stocks that had been leading the market during the last 5 years of the 90s had seen their stocks fall by about 40%. And then they would have analyst days, and you'd go and hear the CEOs talk, and they would continue to make comments suggesting that they had not been affected by the economy or by the slowdown or by the bust. I'm not sure if it was even called that at that time, but they continued to support growth rates of 30 to 50% for their industry niche. And then they'd claim that they expected to be near the top end of that. And this was more than one or two companies. There was a whole host of big tech companies where the CEOs very earnestly would tell you that business was really good and they weren't concerned. Needless to say, either they had no idea what was going on or they were lying, because things only got worse from there, and those stocks fell another 40%. So I think you have to be very careful when you're visiting a management team. And anybody can sound impressive and earnest and accomplished in an office visit. And you can't be swayed by that. You got to look at the numbers. You got to look at the history, the consistency, the persistency of the revenue growth. And if that doesn't add up, then don't lower your standards and buy the stock because you like the CEO. Not a good idea. There's great CEOs that run great companies. There's great companies with not so great CEOs. And there's some CEOs that, they come across really well, but what's that old saying? All hat, no cattle. I'll use that one.
All right. I like it.
We've heard Mario use that a few times.
Okay. Yeah. Great. Another question is, how do you think about currency fluctuations, and do you do anything to hedge currency risk?
You want me to take that? Yeah. So I got to tell you this is the answer is generally no, we don't. And the reasons are multiple. The first one is our expertise is not forecasting foreign exchange. And our intention is to hold a stock for a period of years. And during that period of years, the currency is going to move a little bit one way or the other. We generally avoid investing in the kinds of countries or currencies that are going to have massive percentage change moves over short periods of years. If we're only talking the more typical single-digit percentage kind of annual moves, again, the compounding and earnings growth that we're looking for is going to overwhelm any concern about the currency during the time we hold the stock. So let's not focus on that and make it a good reason to act upon. I will tell you that in my first Wall Street job, which was almost 46 years ago. So Caesar, what are you, 44 years?
I stopped counting now.
John, you're what, 10, 12? I think we're about 100 years of experience right
Yeah.
here. I mean, the Century Club right here.
Yeah.
Yeah, 40. Yeah.
Join the Century Club, folks, Global Growth Fund. So
45 actually.
So
Maybe 44.
So when I first started out, I was at a very prestigious Wall Street firm. My office, or their office, was at 59 Wall Street. And they had a department called Foreign Exchange Advisory Service. And the smartest people from the finest business schools were hired for that slot. Some went to corporate finance, but Foreign Exchange Advisory Service was a brand new service to advise multinationals on how to hedge their currencies. and it prospered for a period of years. And then they closed it down because they realized they couldn't do it. So if you're taking the smartest of the smart and putting them in an office with other smartest of the smart and having them make decisions on forecasting foreign exchange, and they can't do it, and that's all they do, how are we supposed to be able to do that? And so we let the currency do its thing. If somebody can show me a global or an international equity fund that has outperformed its peer group and index for a period of years that hedges its currency, I'd love to know about it. I don't think it's out there. There's also the factor that it costs money to hedge and it takes a lot of attention. I think it's more or less not worthwhile. If you had, on the other hand, because of your asset liability mix or whatever, if you had a reason why you could not afford to take any foreign currency risk, you had to stay in dollars, that's a different situation. But if you're just trying to maximize your investment return, I would let the manager make the decision as to whether to hedge or not. And I think it's been my experience most of the time, don't bother. Caesar, what's your experience? You're English. You've been doing international longer than I have. You may have a completely different point of view.
Absolutely not. Agree wholeheartedly, 100%. But all I can say is that company should have had you doing the currency.
I couldn't
Not
do
the
it.
smart. You could have done it. But in summary, bear in mind that the index is not hedged. So the index that we compete with, 64% US. So the rest is in foreign currencies. So to the extent that a manager is going to hedge, they're actually taking a bet that they can add value to that index. So that is a very powerful, we believe, reason, apart from what Howard said, as to not to get involved. We're invested in primarily developed markets, and if you go back and look at the currency charts, I think I did that actually, and the euro is about where it was 25 years ago now. Within that, it goes up and down. Not what we do.
Got it. No, that makes a lot of sense. So I do believe that you could do it if you wanted to, either of you. You really set your minds to it.
I would also just add at a micro level, a lot of these companies are either explicitly hedging out currency risk or have natural hedges in their business mix. Maybe they have customers in different countries or suppliers in different countries. And so the current FX moves, we generally don't see as creating big fluctuations in company earnings. So I think that's another reason we stay away from it.
Right. Makes sense. And then someone else wanted to know what the management fees are for the fund. So when you were talking about performance, was that net performance that you were citing?
Net of performance.
Right.
Net of fees.
Net of
of
fees.
fees,
I'm sorry.
right.
Sorry. Need some more coffee. Yeah, net of fees. I think it depends on whether you're a institutional investment class share or not on the fees. And I also I should know this. I'm sorry that I don't know, but I know that at one point we had capped the expense ratio at 90 basis points for the Global Growth Fund. And without the cap, I think it's around 130 basis points. The 90, I think, it's either still available to all investors or it's still available to institutional class investors. But honestly, I'm so busy doing what I do that I don't keep up on some of that stuff. So don't hold me to that, but I think that's correct.
Great. Yeah. Well, if anyone who's joining us wants to invest in the fund, we'll follow up with information on how to do that. So it doesn't look like we have any other additional questions from the audience. So I'll close out with it looks like James might have a question. If you can just type it into the Q&A or the chat, we will get to that. And then I'll follow up with my personal question while we wait for that question to come in. what is your favorite investment book that you would recommend if someone's looking to read a book on any investing topic?
One Up on Wall Street by the great Peter Lynch.
There you go. There's Caesar's pick.
Yeah, Peter Lynch is a one of my heroes. But I gotta think for a minute.
I could recommend, I guess it's not explicitly an investing book, but if you're interested in semiconductors, there's a book called Chip Wars, which was written maybe a year ago about the history of the semiconductor industry and kind of how we got from where we were in the 1980s to where we are today. And it's really fascinating context to have, especially if you are investing in semiconductor companies.
So, first of all, I have to tell you that if you went into a library or a bookstore back in the 1970s and 1980s, when we were young and reading things like that, you might find 3 or 4 books on investing. I mean, there was just not much to be bought. And I would recommend Peter Lynch's 2 or 3 books. There was also an investment advisor named John Train, who had his own investment advisory firm. I think it was Train Counsel, maybe, or Train Smith Counsel. And I don't know if they still exist. Very nice man. And he wrote a couple of books on investing that I thought were very similar to Peter Lynch, but had a lot of wisdom in them, if you can find them.
A series of anecdotes from memory.
Yeah,
One of his books was just a series of
Yeah,
different talking about historic,
yes,
bit of
he
a
was
story.
a interesting man with a good business in New York City, and a good writer. And I'm sure that in today's age of information overload, there's hundreds of books on investing now. And I would say that if you wanted one for more textbooky instead of sort of nuanced, it would be the Jeremy Siegel books on investing. He's the MBA or business school professor from Wharton, who some of you may see on CNBC quite a bit. He is appropriately so, in my opinion, a long-term bull on equities, and he's done a good job publishing a soup to nuts piece on investing in stocks. And I think he's updated it once or twice. So I probably put him in there with those other guys too.
Great. I'll have to pick those up. And that was our teammate Scott answering our question about the expense ratio. And Howard, you were correct. It is 90 basis points.
Okay, good.
And then one other question. Do you have any Catholic funds? And so while at the firm, we do have the ability to manage money we do manage money for a variety of religious institutions and can follow various constraints. Do you have any religious guidelines that you adhere to in the global growth portfolio specifically?
No, we don't have any. We're unrestricted. If someone wanted to have a global growth separate account with any kind of guidelines on it, we're happy to talk about that too.
Great. It does not look like there are any other questions from the audience. So thank you guys so much for joining me today. This was a great discussion.
Thank you.
Thank you, Audrey.
Thank you.
Very informative.
Thank you.
Thank you all for joining us.
Thank you for your time.
The portfolio manager's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the individual portfolio manager and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the portfolio managers and may differ from those of other GAMCO officers, portfolio managers, other employees, or of the firm as a whole. Investors should carefully consider the investment objectives, risks, charges and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. Investing in foreign securities involves risks not ordinarily associated with investment in domestic issues, including currency fluctuations, economic and political risks. Not FDIC insured. Not bank guaranteed. May lose value. Returns represent past performance and do not guarantee future results. Current performance may be lower or higher than the performance data quoted. Investment return and principal value will fluctuate, so, upon redemption, shares may be worth more or less than their original cost. To obtain the most recent month-end performance information and a prospectus, please call 800-GABELLI or visit www.gabelli.com.